Good evening, guys. It's so interesting to see all of you for a webinar on IFRS 17, an accounting standard which has just about been introduced. And, before we begin our session, I do see a large number of participants joining. Let's wait for another 3-4 minutes and then we'll commence with our discussion on IFRS 17. Till then, just wait. We'll resume at 5:05. Good evening, everyone. It's so, as I said a minute ago, it's very heartening to see such a huge turnout for our two-part masterclass on IFRS 17. The reason why we have thought about IFRS 17 as a discussion, I'll come to that in a minute. But before we do that, I would want to introduce Zell. I would want to introduce myself. And then, of course, we would get into our main discussion for the day, which is IFRS 17. Zell is the biggest player in as an ed tech in the field of finance and accounts, and we have been providing at great education to students in the online form and offline form in the over the last 9 years. The courses that we offer cover ACCA, which is our flagship product, CFA, CMA, US CPA, Diploma in IFRS, which in a way aligns with the discussion that we are going to have today. We also train candidates on FRM and a lot of corporate trainings on multiple topics in the F&A space. Zell, of course, is headquartered in Mumbai, and we have our branch offices in New Delhi and Bangalore. Zell was started by Pratham Barot, who's an ACC, and Anand Bengani, who is a chartered accountant himself. What started off as an education company in 2014 now has more than 15,000 active students as we speak, and we keep on adding more as the discussion continues. I am Satyamed Nandedkar. I lead the line for academics at Zell Education. I am a chartered accountant myself. I have completed my ACCA, CS, USCMA, and I'm also pursuing my USCPA right now. And I have been a trainer, mentor at Zell for the last 5 years. And above everything else, I love teaching and interactions with all those minds who are interested in getting to know about stuff, which is why I left behind a 9 year career in consulting and I shifted to teaching full time. I have worked with the likes of EY, PwC, and a couple of venture capital funds before shifting base to learning and development full time. Which is why when we were brainstorming on what is it that we need to discuss with people, the topic of IFRS 17 came to our mind the first. Because this is a new accounting standard, this talks about developments in the fields of financial reporting. It is quite interesting to note how the entire focus of accounting has changed over the last couple of years. While today's discussion is definitely going to talk about IFRS 17 and what is it that IFRS 17 provides you. Excuse me, a little sore throat here. A major part of it, the prior part of our discussion today, the first part of our discussion today, will focus on what is the overall change in mindset that we can see in terms of financial reporting across the world. And then we'll get into the nitty-gritties of IFRS 17. This is a two-part masterclass. Today, we'll be touching upon the basics and why is it that IFRS 17 came into existence. And in the next session, which is scheduled a little later in the upcoming week, we'll dive deeper into the technical nitty-gritties that IFRS 17 presents. This being a financial reporting standard, naturally, there are a couple of prerequisites that we'll need to have in our mind. We'll discuss that shortly. So with that in mind, let's begin. IFRS 17 is a new standard that has been issued with reference to insurance contracts. Not long before we in India adopt it into our Ind AS and start applying that to various entities in the country. Right now, the authority for application of accounting standards comes only when the government of India, through the Companies Act, makes it mandatory. The right or the obligation for you to follow these accounting standards comes in place only when the Companies Act makes it mandatory to do so. And that part is yet to happen, but I'm sure when that happens pretty soon, application of IFRS 17 will be done across the spectrum. Now, this contract is an evolution of how the accounting thought process has changed over the years. Chartered accountants of my vintage and before, it still feels a little odd to say that, but I will still say it. Uh, I became a chartered accountant 11 years ago in 2013. Back then, most of the accounting was historical cost-based accounting. In the sense, all the transactions that we recorded were recorded at historical cost. The concept of other comprehensive income was not even a point of discussion. We didn't study OCI or other comprehensive income. Neither did we have such a heavy emphasis on the concept of fair value. Now, I'm sure at some point of time or the other in your studies, in your work, you have come across the concept of fair value. Excuse me. The moment fair value concept started gaining traction, all the accounting standards started undergoing a change in terms of subsequent measurement. For example, IAS 16, which spoke about property, plant, and equipment, and IAS 41, which spoke about agriculture, slowly introduced the concept of using fair value as the basis for subsequent measurement. As in, initial recognition was still happening at cost, and the subsequent measurement, that is, after initial recognition has happened on the balance sheet date, people started applying the fair value principle because now it was introduced via the accounting standards. The concept of other comprehensive income became prominent. So we had to learn newer things. It wasn't a case of unlearn and relearn. We had to let go of what we had studied so far, and we embraced a new way of accounting, which was the fair value method of accounting. Today, as we speak, the idea of fair value accounting extends to all items in your balance sheet, maybe except for a cash and a bank balance. Everything else has to be accounted. The concept of fair value plays a very important role in how the accounting and measurement has to be done. You think of an accounting standard or you think of an item in your balance sheet, and you will have a connected accounting standard which also talks about usage of fair value for subsequent measurement. Certain accounting standards, like the ones on financial instruments, agriculture, they specifically in a couple of cases mention that even the initial recognition has to be at fair value. Why are we discussing all of this? Because the way IFRS 17 has been structured, it takes that principle of fair value, it combines it with a couple of other principles, and then it moves ahead. Insurance contracts, as an idea, were governed by IFRS 17, which was anyway supposed to be a transitional standard, as in, it was never meant to be the be all end all in terms of accounting for insurance contracts. This whole project, I mean, just imagine how long does it take for the accounting standard board to International Accounting Standard Board to formalize the accounting treatment and accounting and measurement of insurance contracts. The main reason for this is because in different countries, the accounting for insurance is different. Certain nuances of insurance are different. Reinsurance operates in a different way. So they had to, this pet project, by the way, started way back in 1997, and IFRS 4 was issued in 2004. Okay, it applies to annual periods on or after 1st of Jan 2005. And multiple discussions, multiple iterations in IFRS 4, amendments, changes, dissatisfactions ultimately gave birth to the idea of having a brand new standard which tackles all the issues that IFRS 4 was grappling with. Which is why IFRS 17 insurance contracts was issued on 1st of January 2023, and that is, when it now becomes applicable. As I said, IFRS 17 is not yet applicable in India. The day our company law board and the accounting standard board in India, which is basically run by the Institute of Chartered Accountants of India, the day they say that we are adapting the standard to Indian needs by creating, say, for example, an Ind AS 117, for example, that would be the day when IFRS 17 principles become directly applicable. Now, IFRS 17 is basically everything under one roof in terms of contract assets, in terms of contract liabilities, in terms of revenue. Because earlier, IFRS 4 spoke about insurance contracts. A part of the accounting was dependent on IFRS 9, which is financial instruments, and which spoke about financial asset, financial liability. Now, all of that has been brought under one umbrella of IFRS 17. Let's understand what is it that makes IFRS 17 uh, so necessary. I mean, as they say, necessity is the mother of invention. What is it that led to the genesis of IFRS 17? Now, let's think about a very basic type of an agreement or a basic type of transaction. Say I go to a shop and I buy this AirPods. Okay, I buy these AirPods, I pay whatever 10-15,000 for it. I pay the money, the material is delivered to me, and I walk home. The obligation is satisfied at that point in time. Today is 13th of May. The obligation is satisfied on 13th of May. The delivery of material also happens on 13th of May. So there is no complexity. Service contracts, on the other hand, anyway create some sort of a complexity. To give you an example, say I sign up with Zell Education for providing coaching on IFRS, Diploma IFRS course. Now, the course is going to stretch for a period of 4 months. If the course is going to stretch for a period of 4 months, and the students have paid money to Zell Education on 1st of June, the course is going to stretch till say the end of October. So June, July, August, September, October, 5 months. Uh, the service will be rendered from July, August, September, October. Say if I have collected 30,000 from one student and say 100 such students, I will have to calculate the percentage completion at the end of each month. And based on the percentage completion, based on the progress achieved, I will account for revenue. Now, if I say that, I am able to achieve equal progress each month, then 1/4 of the revenue will be recognized in every month. When I receive money from students, I cannot call it revenue because I have not performed my service obligation. My service obligation was to conduct the IFRS training, which was going to commence on 1st of July and which was going to end on 31st of October. So I recognize revenue each month as I moved forward towards achievement of certain objectives, which was the performance obligation at my end, completion of the batch. Now, the work that is performed more or less is done evenly, or there are very specific milestones that I can talk about in a service agreement. That there is still some sort of an ambiguity on how exactly will I measure the percentage completion. But in case of a teaching training contract, it's relatively simpler. If I think of an insurance company, say, I have purchased, I want to purchase a life insurance for myself. What I do for that life insurance is that I pay a one-time premium. And once I pay that one-time premium, say it's a term insurance. Okay. I have paid a lump sum premium of 5 lakhs. The insurance policy is going to mature after 20 years, or on the death of the person. Now, if the insurance policy is going to, if the insurance company is going to make a payout against the insurance policy after the death of the person, think about the accounting mismatch it creates. Today, I have received the entire premium from the customer. Say it is 5 lakh rupees. I account for that 5 lakh rupees, entire 5 lakh rupees as income today, because most of the insurance companies right now do not have very clear guidance. And what happens is the payout for the claim is going to happen at the end of when this person dies. So the expense payout will happen at say 20 years from now, whereas the income is accounted for on the date the premium is received. So it creates an accounting mismatch. There will be years in which there is a huge income that is recorded on account of constant premium receipts, and in the year in which the actual claim has to be settled, in that year the insurance company will record huge expenditures because that is when it is expected to satisfy the claim. So premium is received in 2024, death of the person happens in 2044. There is a time gap of 20 years and the amount is transferred at the end of the 20th year as some sort of a settlement of the claim. Now, to my mind, forget IFRS 17, forget any other accounting standard. To me, just the fact that insurance premium is income is recorded in 1 year, whereas payment of the claim happens much later, is enough reason to worry about the fact that there is an accounting mismatch. Okay. So companies used to account for insurance premium as income each year and the claim amount as expense in which the claim is disbursed, which shows significant expense in the year the claim is provided. Even if it is not a term insurance, but it is a typical endowment policy, I pay a certain amount of premium every year, say 10,000. So 10, 10, 10, 10 keeps on getting recorded as revenue. And in the 15th year, when the life insurance company settles the claim, that is when the entire amount is paid. So this creates an accounting mismatch, this creates a difference, and This is something, which is far beyond reconciliation, and you cannot bring it together in any way. So, management accounting records were flawed, and most important, the users of financial statements were not able to understand what is the actual profit of this particular company, because the recording of revenue and the recording of claims, which is the main expense, was quite skewed. To overcome this problem, IFRS 17 was issued. Now, measurement under IFRS 17 is based on updated estimates and assumptions, reflects the timing of cash flows, discount rate, and the uncertainty of insurance contracts. Naturally, the uncertainty factor, the risk factor, is something on which you will have to take some sort of an input from an actuary. An actuary will, based on the mortality rate, based on the overall trends, based on the percentage of claims which are settled, based on the percentage of claims which are filed, the current age of the person, the date on which the policy was taken, habits, all of that taken together, he will give you a measure of uncertainty relating to this particular insurance agreement. So, this will give you a hint of when exactly is the liability likely to arise. But the question still remains, I'm receiving premium right now. I have insured, or the sum assured at this point is, say, 50 lakh rupees. That is my liability at the end of the, say, 20th year, because premium will be paid year 1 to year 18, for example, under the life insurance contract, and the payout of the claim will happen in year 20. If this is the case, then should I record for 50 lakh today as an estimated outflow? But a question might come to my mind that this 50 lakhs is going to be paid after 20 years. I should not record it at 50. I should record it at its present value. So it should reflect the timing of cash flow, which is the discount rate, and the uncertainty of insurance contracts, which is the risk adjustment factor. Now, if you have studied financial management in some basic level also, you will realize that when we estimate the cost of equity, we use something known as beta. Now, this beta is a measure of volatility. Okay. Now, beta is a measure of volatility there, and it helps me to calculate the expected cost of equity. In this case, in IFRS 17, there is an element of risk involved, because see, as much as you use these actuarial mathematical models, statistical models, to find out that roughly this is when the death is going to occur. What happens in a year like 2020, when suddenly there is COVID widespread in the world, and unfortunately a lot of people have died, and now the insurance company has to settle the life insurance, the life insurance claim. So this element of risk has to be incorporated in the discount rate, and you have to calculate the present value of future cash flows accordingly, so that you can estimate the amount of liability correctly. This is 50 lakhs that you have to settle at the end of n number of years, but the rate at which you discount it to bring it down to its present value, that is something that IFRS 17 gives you guidance on. Now, IFRS is a principles based approach. Okay. IFRS, unlike US GAAP, will not say use 14.7% as the rate of discounting. No, it will give you the scope to interpret. It will give you the scope to apply the principle to your specific situation. The second idea that IFRS 17 has given out is contractual service margin. When I talk of the contractual service margin, it basically indicates expected yet unearned profit, which is only recognized upon delivery of the insurance service. Aligns with other industries where profit is recognized upon delivery of goods or services. When you're talking about construction contracts, again, there is a percentage completion approach that is taken there. But if it so appears, that the costs that you are expected to spend are far more than the revenue, then naturally the accounting part will have to change. There are different nuances involved there. When we are talking about the contractual service margin here, it talks about expected, that is unearned profit, which is only recognized upon delivery of the insurance contract. Delivery of the insurance service, see, when I go to an insurance company, I pay 6,000 medical insurance premium each year. Their delivery of service happens when, unfortunately, I have to get admitted for a surgery, and then the money has to come from them for tackling the costs of that surgery subject to the amounts that are mentioned. Now, the contractual service margin indicates expected yet unearned profit. Unearned profit because see, at this point, you are only receiving the premium year on year from your customers. You are yet to deliver the service which will only happen, which is incumbent on the person falling sick or the person passing away, unfortunately. So, this contractual service margin is basically my unearned profit, and IFRS 17 has come up with a basic principle which we will study in the next part of the session of spreading this unearned profit over the entire life of the contract. What it also makes possible is that it facilitates easier evaluation of insurers' performance because now all of them are going to apply the same principle for accounting. And it also allows comparison over time and across other industries. Now, today, the way things stand, it's not possible for you to compare the performance of insurance with the performance of banking because the way banking companies record revenue and cost and the way insurance companies record revenue and cost, there is no way the two can be compared. Now, what we are going to understand is we'll see a basic illustration of IFRS 4 versus IFRS 17, the details of which, in the other nuances, we will take up in the second part of the masterclass. Okay. So what is the situation right now? The situation right now is framed with respect to a single premium term life insurance. Products like these exist in the market. You pay a lump sum premium of 20 lakhs, and on maturity for this term life insurance, you get maybe say 1 CR, for example. Assumptions made for purpose of measurement. The starting number of policies is 1000. The insurance contract is entered into for a term of 5 years, and sum insured is 5 lakh. So 5 lakh into 5, no, you cannot multiply 5 lakh by 5. 5 is number of years. 5 lakh has to be multiplied with the number of policies, which is 1000. This is the insurance contract. This is the sum insured. The death probability in each year is estimated at a conservative level of 1% for purposes of mathematical reserves in IFRS 4, while the best estimate of the mortality rate is 0.5%. Regular annual expenses are estimated at INR 4 lakh for the entire portfolio. The single premium is euro 29,000 per policy, and non-recurring acquisition costs are euro 9,000 per policy. Now, if I were to think about it in a basic understanding, these non-recurring costs, because they are incurred at the beginning, they could be acquisition cost, they could be costs that you pay to the sub brokers or something. That is 9,000 rupees per policy, and the regular annual expenses are 4 lakhs per annum for the entire portfolio. Single premium is 29,000 rupees per policy. So right now the total premium amount would come to 29,000 into 1,000, which is 2.9 million. We have made a couple of assumptions here. What are these assumptions? Assumes that insured individuals do not resign before contract termination, and you are disregarding investment effects. What does that mean? See, the focus of development of IFRS 17 is to show you and tell you how the accounting part of it works with respect to these specialized insurance items. So the fact that insurance companies will use your money, invest it elsewhere, earn income on that part has been disregarded in the discussion because that is anyway a parallel stream of thought. Mathematical reserve creation involves considering a cost component where acquisition costs are deferred by the insurer. And see, why do you think acquisition costs are expected to be deferred? See, acquisition cost is 9,000 per policy, and you have issued 1,000 such policies. The fact that you were able to acquire an insurance policy was because you are able to acquire a customer to whom you sold insurance policy. The whole reason behind getting that customer to you was that you spent some costs on acquisition, on marketing, on different aspects, and the policy is something that you are going to service over a period of 20 years. So it doesn't make sense to record all the costs in one go. the cost should be, the acquisition cost should be deferred and amortized on straight line basis by the insurance company. This is one of the requirements now. And uh, the mathematical reserve part is basically uh, the expected cash flows that the company is expected to encounter. All of those have been incorporated here. Let's talk about how the entire mechanics of IFRS 17 work. In order to measure the contract, in the calculations presented below, we assume that for the purpose of reporting in accordance with IFRS 4, then we'll see what happens under IFRS 17 and we'll have a comparative view of both. Okay. In order to measure the contract, first we have to determine the expected amount of cash flows that are directly related to the contract, to include premium, benefits, and costs along with those relating to acquisition over its entire term. There are claims and benefits that you have to pay. Then there is the acquisition cost that we saw here, 9,000 per policy into 1,000 policies. We also considered administrative expenses. How did we get that 20 lakhs? We multiplied the 4 lakh into 5 because this is a 5-year thing that you are considering. And claims and benefits. The idea is that if you see here, the death probability in each year is estimated at a conservative level of 1%. So what is the total amount insured? Total amount insured is 5 lakh into 1,000. That is the total amount that you will have to settle as claims because ultimately these individuals are going to die someday. Okay. Now, 5 lakh into 1,000 into 1% is 2,50,000, but this is 1% per year. Each year there is 1% of the people who have taken an insurance policy on a conservative level, they will die. So over a 5-year period, the total outflow is going to be this much. The total amount that you have received as premium is 2.29 million. And this is the other amount that this is the amount you have received. These are the costs that you have to pay. 12.5 million here, and then the acquisition cost of 9 million and administrative expenses of 2 million. So the total is 5,50,000, which under IFRS 4 was usually at one time. Now, profit recognition under IFRS 4 versus IFRS 17, the entire surplus of collected premium over the recognized reserves is realized immediately in the first year, and subsequent profits stem from the difference between expected and actual benefits paid. If the benefit paid is lesser than what you had accounted for, then naturally that differential amount is settled. Now, a question might arise, why is there a difference between the amount that I am settling and the amount that I have promised to the customer? See, insurance contracts are subject to the fact, say I'm talking about medical insurance, they are subject to the fact that, you do not smoke, you do not or maybe consume alcohol, and you consume it in XYZ proportion. Only when you take due care of your health is when these insurance contracts will be honored. Say, for example, if you have not done regular repair and maintenance of your vehicle, the insurance company is under no obligation to pay you the insurance, to pay you the claim if your vehicle unfortunately meets with an accident. Like it's raining today, for example, and in Mumbai, and you keep your vehicle in the open and a tree falls on it, then probably you did not take due care of your vehicle. So the insurance company might not pay you. It of course depends on the terms in the contract. So these differences that you take care of, they are adjusted as and when the amounts are received or the amounts are paid. Another example, sometimes what happens is under insurance contracts, there is a no claim bonus that is paid, which means if you have a medical insurance and if for 5 years continuously you did not claim a single penny from the insurance company for your medical checkups and your hospitalizations, then they will give you a one-time bonus which is because you did not claim anything for the first 5 years. In that case, this is an additional cost for the company, and it is adjusted against the premium that they are going to collect from you. So this is where the subsequent profit part comes from. In contrast, IFRS 17 defers profits through contractual service margin, releasing them gradually as the insurance service is delivered. It is spread over the entire life of the insurance contract, or as the insurance service is delivered, in the same way as you do for any other business. IFRS 4 allows immediate profit realization upon premium collection, while IFRS 17 spreads profits over the service period. And under both standards, profits under both standards arise from releasing safety margins in reserves, but are recognized differently. Ultimate amount of recognition remains the same. It's just the timing which is different, and that in financial reporting, it creates a lot of change. Despite timing differences, total profits remain the same. And see, we have a zero investment assumption. So that part we are not considering. Ki what happens when the insurance company collects the money from you, invests that money in mutual funds or FDs or whatever, and earns income on that. We have not accounted for that income yet. So if you observe under IFRS 4 or under IFRS 17, uh, when it comes to measurement of insurance liabilities also, you will have to bring them down to the present value at the appropriate rate of discount. Whereas under IFRS 5, under IFRS 4, it is the calculation happens as we saw earlier. The total amount that you will end up settling, that remains the same. I'm repeating, that remains the same. It's just the year-on-year value which undergoes a change. Now, when the transition happens, IFRS 17 will have far-reaching impacts, not just on insurance companies, but even on those who provide reinsurance services, for brokers, for sub-brokers, for everyone. IFRS 17 will have an implication. IFRS 17 also will require you to collect data in a better way, to keep proper records, because the revenue recognition and cost calculation and cost recognition will also change significantly. And it's not far away. That date is not far away when in India as well, we will have to apply IFRS 17. Right now, as I said, it has not been made mandatory by the government of India through the Companies Act, but the moment they do that, that is going to change. Now, earlier, comparability was difficult under IFRS 4. Now, because the approach to calculation is data-based, it is not based on your whim. The comparability across countries, comparability across industries becomes possible. Also, comparability between different insurance products becomes possible. Earlier, you were restricted only to if life insurance you are comparing, you would not be able to compare it with the accounting of a general insurance company, because general insurance company works in a different way. They work on motor, they work on health, they work on others. Life insurance company, the whole approach itself is different. Okay. Now, the transparency is more, and the information about profitability, while the overall profit is the same, yet the year-on-year calculation, the year-on-year recording becomes simpler, becomes better. And ultimately, the risk adjustment parameters, you will end up separating the components here. The risk adjustment will have to be considered while calculating the discount rate. You will go with the fair value approach. You will take expected value of future cash flows, and you will consider all these factors. Excuse me, you will have to think about aggregation, disaggregation. Aggregation is clubbing items together, disaggregation is separating them. All of these will have to be considered. And then ultimately, the final part of disclosure, which is essential for the readers of financial statements. The variability in terms of timing of cash flow in insurance contract is very important. An entity, the accounting policy has to now align with what IFRS 17 says. Earlier, a lot of them ended up violating the requirements, and each of them came up with their own way of recording insurance premium. Like a couple of insurtech companies that I worked for, they would record premium as income immediately and claims as cost subsequently. Now, with IFRS 17, all of them will come on the same page. Okay. IFRS 17 applies to of course, insurance contracts issued by the entity, reinsurance contracts held by the entity, and covers investment contracts with discretionary participation features issued by the entity, provided it also covers insurance contracts. Now, if you were to think of earlier, a revenue from contract with customers, IFRS 15, this was a special case there. Now it has been carved out into a separate standard. Right now, as we speak, the diploma IFRS course or even the ACCA course has not incorporated IFRS 17 as a part of its syllabus. It's still out. It has been introduced quite recently, which is why ACCA has not made it compulsory in any way. As in it has not you know made it as a part of your study curriculum. But as time passes by, I'm sure that will also be included. So all of those who are interested in pursuing the ACCA qualification, excuse me, all of those who are interested in pursuing the diploma IFRS qualification, you will have all of these as a part of your curriculum, but not right now. It will still take some time. No, we are very, at least I am waiting with a bated breath to know when exactly do we, get to interact with IFRS 17 in a practical based situation also. Right now, it's very theoretical in nature. Similarly, if you are studying US GAAP, there are implications, but not of IFRS 17. Under US GAAP, there is a separate thought process on how that part is supposed to work. Now, for you to understand, see, you are at a point, I don't know the exact age or the professional background, but the world of financial reporting is evolving continuously. And while IFRS 17 is not covered by ACCA right now, ACCA right now covers a whole lot of IFRS and a whole lot of accounting standards. And what we at Zell do is we do not, of course, we teach you how to study and apply the accounting standards, but more important than all, even if we don't teach you IFRS 17 now, we will equip you with enough skills which will make it possible for you to utilize the concepts that we have covered and apply them to any real life situation. So when you are enrolling for a professional course, do not enroll for it for the only for the extrinsic benefits that you see. Also understand that when you join an institute like Zell, what we are going to do is we are going to imbue those skills in you. Let there be another accounting standard. If not IFRS 17, let there be another accounting standard out there. It will still become, it should still be within your ken to be able to use that, read that, and apply that at your professional work. So if you have not thought about these courses, please give it a thought. Think about enrolling with Zell for ACCA, for Diploma IFRS, for the other courses also that we have on the platter. Do make an informed decision. What I'm going to do is I'm going to show you the, I'm going to share with you one phone number. And of course, you can use that phone number to get in touch with the ACCA experts and, experts for other courses at Zell. It's imperative that you take this decision right now, because this I'm sure a lot of you are done with your 10th and 12th boards, or you have finished some sort of a professional qualification, and it's the right time for you to take a decision about uh, propelling your career in the right direction. And what better than a professional course to get it done? So do make sure that you get in touch with our experts. Our experts are available round the clock to help you, to guide you, and to make sure that your individual queries are answered. Zell has a LinkedIn page. Please follow the LinkedIn page. We have our own YouTube channel where more and more informative content will be posted on a regular basis. Make sure you follow that. Uh, get in touch with the Zell experts. You can get in touch with me. I'm there on LinkedIn. Our entire setup is there on LinkedIn. So this is the number. So for any queries, make a note of this number, and please join the second part of the masterclass also, because today, while we built the base, in the next class, we are going to apply all of that and understand how exactly does IFRS 17 operate. With that in mind, I hope you have noted down the number. With that in mind, I will ring the curtain on today's webinar. Thank you so much for attending on a Monday evening. We really appreciate this, and we expect to see you in one of our classes down the line. Thank you so much. Have a good day.